Do have a bit of a pickup here. Dow's good for about 170. There's the S&P 500, 1/3%. NASDAQ with a nice rebound today. 10-year note yield is falling. We're going to get into all of that. It's at 434. So, Shan, we're about to post the best month since July of 22. Is it time to get more bullish? I look squarely at you and ask the question, and you know exactly why I'm starting with you.
Because I have been a little bit more cautious this year.
Yes, you have. Is it time to change?
So, listen, are we talking about the next 4 weeks, or are we talking about the next 6 months? So I think if we're talking about the next 4 weeks, Scott, there, again, very few hurdles to upset the rally that we are enjoying. One of my concerns coming into this week was that we would see maybe perhaps weaker than anticipated retail sales. Did not see that. Certainly seeing stronger than that. Expectations potentially of some changes in Fed speak, some indications that perhaps inflation is not going the way that they thought. We obviously are not seeing that today either. So I think if you're looking at from here to the end of the year, and bond auctions, those have been going better than expected. So if you think about Treasury issuance. So from here to the end of the year, you're right. There's not a lot to upset.
Why are you only willing to give it for 4 weeks?
Because if you think about what's happening underlying in the economic data, we continue to see some slowing of economic data. But more importantly, think about the positioning, Scott. Think about where we were at the beginning of 2023. The 3 sectors that have done really well this year, tech, communication services, discretionary, pretty much oversold coming into 2023. If you think about what was preferred coming into 2023, more defensive sectors. We've seen a lot of pain there. Healthcare, staples, utilities, real estate. So if I look at positioning my portfolio, I think Rob was on here the other day talking about, are you going to want to take those gains in this environment? No, you're probably not going to want to trim your winners right now. You're going to want to go into the year with those on your books. You go into January and February, I think there might be a little bit more pressure. And more importantly, looking at the potential for multiple compression of the names that have done really well this year, there are other opportunities in the market where you could see some multiple expansion, especially for an environment where we do expect revenues and earnings to grow, but perhaps at a more muted pace.
Jimmy, all in. Is Shannon still too cautious? Is it time to get more bullish?
Well, I do think you're too cautious, but I don't think you're out of your mind. That's not what I'm saying at all. And I don't think
bulls
like me.
That's good, because I didn't ask you that. I just asked if she's too cautious.
Okay, but the bulls like me generally acknowledge what the bearish case is, which centers on the fact that there are lagged effects to Fed hiking. And the reason I'm going on about this is because these are real effects, and we see it in things like consumer delinquencies. We think about that in the context of the resumption of student loans. We wonder what capital budgets are going to be in corporate America as far as hiring goes next year. So there's validity to being bearish. However, the burden of proof, in my opinion, is on the data to prove the bulls wrong. What that means is that the inflation data has to come in too hot going forward from here. I'm actually, Scott, not talking about this week's PCE because that's looking at October, which is a long time ago. But next week, when you get wage gains in the November labor report, that will be the first indication of what November inflation is doing. For the bulls thesis to work out, the Fed has to be done. Let me state that again. For the bulls thesis, i.e. mine, the Fed has to be done raising rates. And so what I'm really paying attention to is next week's labor reports and then the following week's CPI, PPI. Those have to come in soft.
You're looking at that 10-year right there?
Well, what that's saying? What is that saying? That's saying the Fed's done. And if they're done, I think this rally continues. And I think there's a point in time where Shannon looks at it and says, okay, the Fed's done, and we get in.